Jeff Christian, Managing Director of the CPM Group, returns to talk about gold and the major trends affecting the gold price this year. Welcome back, Jeff. You have a 2022 gold yearbook that's going to be released soon. This is an annual report that you come out with every year. Is that correct?
This is an annual report. It actually goes back to the J. Aaron days in the early 1970s. Okay. Annual gold review and outlook. Yes.
All right. So we're going to be covering some of the snippets and teasers from this release and the major themes that you'd like to discuss today. But first, I want to touch on something fun. You have submitted to me questions that were sent to you by either readers or people that you know. Some of these are relevant, and I'm just going to start and go through this list. Why are gold prices so low? Yeah, Jeff, why are they so low right now? Why is gold so low?
Yeah, it's funny, but I guess it has to do with strange conceptions of what gold prices ought to be. The reality is, gold prices reached a record intraday price of 2080 this month, March, and on an annual average basis, last year gold prices were higher than ever before. They were higher on an annual average basis last year than even in 2020, because 2020 saw low prices until August when the price shot up. The price shot to 2040 in August of 2020, and then it came down, and it traded basically between 1780 and say 1860 for much of last year. And people were saying, well, it's $200 lower than it was. And then there are these other people who think it should be $10,000 for some strange reason. And so they look at these gold prices and they say they're low. They're record high prices, very profitable for most mining companies. But some people just have outsized expectations of what gold ought to be.
I think some people have looked at the way gold has performed in prior bull cycles. If you just take a look at the bull cycle leading up to the high in 2011, gold climbed from a few $100 all the way to almost $2,000 in change. So the rationale is that this bull cycle that we've seen since the start of 2019, 2020 hasn't mirrored the bull cycles in the past in terms of magnitude. So we should be expecting higher gold prices, right?
Well, the way we look at it is we look at, you could say in terms of technical analysis, we look at a gigantic measured move, and the price rise from 2000 to 2011 was the first leg. And then you had this downward correction from 2012 till 2019. And now you're into the early stages of the second leg up, which should be about the same magnitude as what you saw from 2000 to 2011.
This next one is rather good. Will interest rates kill the economy and gold prices?
Yeah, I don't think they will. Interest rates are negative for the economy and the stock market and commodities and gold when they're high and they're rising to even higher levels. If you go back to the 1970s and other periods of time where interest rates rose and threw us into a recession or pushed the gold price down, interest rates are going from 5% nominal terms to 21% nominal terms. Now we're in a situation where interest rates are going from 25 basis points, 0.25% to 3%. And I don't think anybody's going to get so excited that they can earn a nominal 3%, a negative 4% on an inflation adjusted basis, that they're going to say, oh, I'm not going to invest in new plants and equipment. I'm not going to buy stuff. I don't need to buy gold. So I think the interest rates could rise, as the Fed has said it plans to increase interest rates. They could rise 3% this year, but they're rising from virtually nothing to 3%. I don't think that's going to be a high enough level to throw the economy into a recession or to convince investors that they shouldn't be buying gold.
Well, that's a good point. A lot of economists do agree with you that the interest rate hikes are not sufficient to bring down inflation. Now, let me ask you this. What level does the interest rate need to be in order to be effective and actually bring down inflation? Recall that in the Volcker days, we had double-digit inflation and double-digit interest rates. Do you think interest rates need to match the level of inflation exactly then, or perhaps even higher?
No. And let me clarify what I meant to say. I don't think that interest rates will rise so high as to throw the economy into a recession. I actually think that interest rates will rise high enough to have an anti-inflationary pressure. But there are a bunch of other factors that are going to emerge, especially in the second half of this year, that will be effective in reducing inflation rates. And so I think that we expect inflation rates to come down in part because of the increase in interest rates, and in part because the Fed is sucking money out of the, or will be sucking money out of the circulation. So they will be sterilizing the inflationary consequences of their past monetary largesse. The big issue on inflation is the fiscal policy that the Congress and the administration run, and that really needs to come under control to really lower inflation. But I think that for a variety of cyclical and secular reasons, you'll see lower inflation in the second half of this year.
Well, you have talked to me about the possibility of a recession coming up. Now, the inverted yield curve is something that concerns a lot of people. We're not inverted yet, but the yield curve has been flattening. Now, is that a leading indicator for you, at least, of a recession?
You know, the relationship between inverted yield curve and a recession has never actually been that great. And, you know, people say, well, an inverted yield curve has predicted a recession from World War II or until 2008. And actually, the relationship is that the yield curve will invert anywhere from a year into the start of a recession to concurrent to the start of a recession to 2 years before the start of a recession. So it's not traditionally a good predictor of recessions. In addition to that, the relationship between interest rates and economic activity really has shifted since the global financial crisis and the Great Recession of 2008. So the relationship's not quite what it is. You know, the joke is, I guess, that an inverted yield curve has predicted 10 of the last 3 recessions. So I don't know that it is predicting a recession. CPM Group is predicting or projecting a recession sometime around 2024 to 2026. And I will say this, there is a relationship between an inverted yield curve and recessionary economic conditions, but it isn't true that an inverted yield curve always precedes a recession.
So you're predicting a coming recession. You're not alone. Financial institutions are starting to agree with you. Goldman Sachs, for example, upgraded their chance of recession to 35% over the next year. That was their timeline. So a little bit sooner than actually your prediction. Now, if not for interest rates rising to a certain level, what's going to trigger a recession then?
Well, I think a variety of factors. First off, the rise in interest rates will contribute to it, but I think there's some cyclical factors there too. And also, as interest rates, we're talking about Treasury rates when we're talking about 3%. The thing to really watch will be the interest rate spread between, low risk Treasuries on the one hand, or benchmark interest rates, and what corporations and individuals are paying. Right now, what we're seeing is that the markets are underpricing risk. So there's a very small spread between what the Treasury has to pay to borrow money and what corporations and individuals have to pay for money. One of the things we will be watching is an increase in that spread. Whereas as interest rates rise and we get into the later stages of an economic recovery and you have political issues in the United States, Europe, and elsewhere, and on a global basis, you have a number of factors that are probably going to cause lenders to say, if I'm going to be lending to smaller companies or more risky companies or consumers, I want more than I'm getting. So you should see a widening of the spread between what companies and consumers pay to borrow money versus what governments pay. And that, I think, will be much more damaging to the economy than an actual increase in Treasury interest rates.
Okay, interesting. Well, let's move on to the precious metals then. Gold has had a good start to the year relative to some other risk assets. What's your projection going into the next year? And let's discuss some major trends, tailwinds, headwinds, or otherwise.
Well, I think gold prices are going to stay high and volatile as long as it's not clear how the Russian invasion of Ukraine shakes out. at some point there's going to be a resolution, or there'll be a clear path to a resolution, and that'll take away some of the risk premium that you're seeing in gold. In addition to that, I think that you will see rising interest rates calm down gold prices a little bit. And you also see, our expectation is starting in May and June, you'll start seeing lower consumer price index increases. So the rate of change in consumer prices should slow. And you should see that starting to emerge around May or June of this year, and then going into the second quarter. And in that kind of environment, we expect gold prices to come off. We think they may well hold above, say, 1840, 1860, and they could spike down to 1780 at times. But I think that generally speaking, gold prices go back into a range similar to what we saw in 2021 for the remainder of this year. And then in 2023 going forward, we think they rise modestly initially. And then as we get into the later stages of an economic expansion, we think that gold prices will start rising more rapidly.
Okay. Now, investment demand, you wrote in a note to me, you said that investment demand more than doubled from 2018 and 2019 to nearly 40 million ounces in 2020, pushing gold prices to a record. So investment demand, are you suggesting that it's going to continue to be an important driver of the gold price going into next year and beyond?
Investment demand for physical gold has always been the single most important determinant of longer term gold prices, and it will continue to be. When investors only want 17 million ounces the way they did in 2018, the gold price is not going to rise. When they double that and they say they want 40 million ounces in 2020, the price is going to rise from $1,250 to $2,040. When they say, as they did in 2011, I don't want 40 million ounces, I want 27 million ounces. So I'm not going back to that 18, 17 million ounces of 2018, 2019, but I want less than I wanted in 2020. Then the gold price actually rises 1.3%, which is what it did last year on an annual average. So, investment demand is really the key driver for prices.
What about investment demand for futures, for ETFs? Do those have an impact on the price?
Futures determine the shorter term price moves, mostly on an intraday basis and a longer term basis. The physical demand for gold from investors and central banks is the primary factor determining longer term prices. And it's quite clear, if you actually do the statistical research, that the longer term prices are more influential on the short term futures price changes than the other way around. So the futures markets really don't drive the gold price. They cue off of the physical gold market, and the futures trading will have an effect on the shorter term price moves.
Okay. Now, when you're talking about investment demand driving up the price or driving down the price, depending on where the demand goes, which are the actors you're talking about? Clearly, not everybody can influence investment demand to a significant degree. If I go out and buy some physical bullion, myself, I'm not going to be able to move the price. Are we talking about an institutional level or broader retail level, or perhaps on a central bank level? Who are the most important actors, in other words, when it comes to investment demand?
Central banks are important, but actually it's it's the small retail investor who collectively has the greatest influence. A lot of institutional investors don't invest in physical gold, or some of them invest in futures or options and such. Some of them do invest in physical gold, but it's really in individual investors. Now, some of the retail individual investors have a lot of gold. I mean, we have some clients who have large amounts of gold,
Sure.
But hundreds of thousands of ounces in some cases. But they obviously have a more immediate impact that if they're buying or selling than you or I. But it's really the collective demand of a lot of retail investors that seems to be the most important factor.
Okay. Well, so given that you think there's a recession coming up, given that interest rates are going to rise, let's recap one more time. Investment demand for gold going into next year, strong or not?
We think it's strong. It's not as high as 40 million ounces in 2020, but it's not as low as 18 million ounces in 2018, 2019. We think that this year you'll probably see about 27, 28 million ounces. 2023, 2024, you'll probably see incremental increases in investment demand, which will be reflected in rising prices.
Mm-hmm. All right, well, let's talk about central bank buying now, and then we'll close out the conversation there. You wrote in a note to me, more countries bought more gold at higher prices in 2021. China and Russia, the big buyers from 2008 through 2019, did not buy. Other countries bought. So let's recap what happened there. So the two large buyers, China and Russia, abstained from purchasing gold in large amounts in recent years. Why is that?
Well, for different reasons. First off, Russia has 74 million ounces of gold. It was spending last year really building up dollar reserves and foreign currency reserves in advance of its plans to attack Ukraine. But it does have about 20% of its monetary reserves in gold, about 74 million ounces. And it pulled back. It actually started to pull back in 2020 when the oil price collapsed, because oil and gas exports are their major source of revenue for the country, foreign exchange coming in, and also government revenues, both from taxes of the oil and gas industry and from other duties and fees that they collect for the exports. So when the oil and gas prices fell in the early stages of the lockdown and pandemic, that really hit the Russian economy, and it also hit the Russian government's treasury. So they've stopped buying for all intents and purposes in early 2020, and they haven't come back. China also has a lot of gold, about 63 million ounces at this point. It's about 3% of their monetary reserves. They're quite content. Most central banks are very price sensitive. And in the past, what you saw, and you can look at a price chart, like for example, in our gold yearbook next week, we have a chart of central bank gold buying. When individual private investors push the price up, central banks pull back. When investors pull back from buying as much gold and the price subsides, central banks come in and buy on the dips. So you saw, for example, central banks buying a lot of gold when the price was weaker in 2018 and 2019, investors weren't buying. When investors came in and bought twice as much gold in 2020 as they had in the previous years, and they shot the price up, central banks pulled back. When the price came down from that intraday peak of 2040 in August of 2020 and was trading around 1780, 1820, you saw a lot of central banks buying gold. It wasn't China and it wasn't Russia. It was a lot of central banks that you don't necessarily see as, or haven't necessarily seen as gold buyers, but they were coming in there. So you had 4 central banks buying, each of them bought more than 2 million ounces of gold last year. You had 2 other central banks that bought nearly 1 million ounces of gold, and you had more than a dozen other central banks that were in there buying smaller amounts of gold, and they were buying around $1,800. Now these guys are price sensitive. They were buying at $1,250, $1,300. When the price rose, they stopped buying. When the price came down, they started buying again, but they started buying around $1,800. Central bankers buy gold as a monetary reserve, not as an investment. So they have an open-ended holding period. And what the central bank community was telling the gold market last year was, we used to think that $1,200 or $1,300 was a cheap price for gold. Now we think it's $1,800. I mean, that's an incredibly bullish message. Central banks have said, no, we think gold prices are going higher, and $1,800 is a bargain price to buy.
So generally then, would you say that central bank buying activity would be a good leading indicator for the price going higher?
Traditionally, I don't think that it has. Central banks buying obviously has a positive influence, and they're big ticket items.
Well, not so much that they're an influence on the price. You have explained that retail investors collectively are more of an important investment demand driver. I'm just saying that central banks, being as price sensitive as they are, maybe they've got some smart analysts working for them, and they know that prices are going to go up soon, so they're buying now.
They get good advice, I will say that. But yeah, they had good advice and they're very level-headed. And like I said, they tend to be bargain hunters. They're not necessarily short-term investors. A sovereign wealth fund or an institutional investor might say, I'm buying gold with 3 to 5 year time horizon. A central bank says, I'm buying gold with no time horizon. I'm buying gold as a monetary reserve asset that I'm going to add to my monetary reserves and basically leave it there until I need it for an emergency. Like if I attack a neighbor and everybody freezes my foreign exchange reserves, I might have to sell some of my gold in order to pay for imports. That's the way central bankers look at their gold. And so they do have an influence on the price. The collective influence of central bank buying and selling seems to be lower than in terms of percentage influence on the price of gold than the collective influence of retail and private investor buying. But it's still up there. It's number 2 after investment demand in terms of influences on determining the price direction of gold.
Okay, Russia. People want to know what the Russians are gonna do now that they've invaded Ukraine. Again, one of the largest gold reserves in the world. What's your take?
Well, they do have 74 million ounces of gold. They have about 400, at the end of January, they had about $470 billion in foreign exchange reserves. About 200 billion of that has been frozen as part of the sanctions once they started the war. Another big chunk, perhaps as much as 200 billion, was held in yuan at the People's Bank of China. And Russia, a couple of weeks ago, said to the People's Bank of China, hey, we'd like our money back. Can we have it in dollars, by the way, not rubles, but dollars? Or, and the People's Bank of China said, no. There are international sanctions against the Central Bank of Russia now. And while we don't have sanctions against trading with you, we don't want to run afoul of those international sanctions. So we're not giving you your money back. So Russia had a war chest of $470 billion in foreign exchange, most of which is tied up and frozen now and will be frozen for a long time to come because it may well be used to pay reparations and reconstructions after the war with Ukraine is over. So they have reduced amount of foreign exchange reserves to pay for imports. They have reduced for foreign currencies coming in because of sanctions on oil and gas exports to the United States and a couple other countries. Right. They need money. They have 74 million ounces of gold. That gold is stored in Moscow as opposed to offshore. So it's available to them. So they may well have to sell some gold in order to have currencies for imports.
That's right. They may have to sell it, especially to finance this war. But could they, is the question. I'm reading this article from Bloomberg. This is not exactly new news. It came out a few days ago. U.S. targets Russia's giant stash of gold in new sanctions. I'm just going to read the first 2 paragraphs. The U.S. Treasury issued a notice that gold transactions with Russia are prohibited, citing executive orders signed by President Joe Biden. The directive is the first time the agency has made it clear to the gold market to stop dealing with sanctioned Russian entities. Russia has spent years building the 5th biggest stash of gold in the world, and it's being targeted now because sales of it could shore up the ruble, which has plunged as global economies isolate Russia following the invasion of Ukraine. So the U.S. is sanctioning Russian gold sales. Is that going to be successful?
It will be partially successful. There are any number of entities that will not trade gold with the Central Bank of Russia. And, even before you make the sanctions on gold, you had sanctions on the Central Bank of Russia. So that effectively precluded trading business if you want to follow the rules. There will always be bullion trading companies and entities that are willing to skirt sanctions. There will always be central banks and other governments that are willing to skirt the sanctions. So it's something of a barrier for the Russian government to sell some of its gold, but it's not necessarily a completely impervious barrier.
Well, let's assume that the barrier is not an issue and they do successfully sell some of their gold to finance their activities. Would that significantly impact the price of gold? Russians unloading their gold?
Probably not, because whoever buys it probably would not necessarily have been buying that in the open market, and B, probably would not be selling it in the open market. If someone says, I will buy your gold nefariously and I will trickle it into the market so that I have currencies that I can either remit to you or that I can keep myself, then it would have a negative effect. But there's a good chance that whoever would be buying it would probably say, I'm just going to sit on it. Now, let me amplify that. A central bank that might be doing this might say, this is a way to pick up gold at a discount. So I'm going to do it and I'm going to keep the gold and it has no effect on the price. Somebody like a bullion trading company or a company that has the wherewithal to buy and sell precious metals might say, okay, I can buy this gold. I'm going to charge you a discount because I'm breaking the law, I'm taking risks, et cetera, et cetera. You're a pariah state. I'm going to buy the gold. I'm going to pay you a discounted price for gold, and I can turn around and trickle it into the market at the market price and make a nice spread between what I'm paying you for your gold and what I'm selling it for in the market. So in that kind of environment, you could see it having a price effect. But I think that that's a less likely thing that would happen. I think the more likely channel would be that they would sell it to a central bank that wants to add to its gold reserves and is willing to buy gold at a discount.
Okay, excellent. Well, fantastic analysis as always, Jeff. Thank you for your insights on central banks and your outlook on gold. Now, where can people access your gold report, the annual 2022 gold outlook? Where can people see that?
There are two ways to do that. And one is you can go to cpmgroup.com and you can buy the report. You can pre-order it now, you can buy it and download it as a PDF. We circulate it, we sell it as a PDF these days. And the last page of the report says, excuse me, if you want to print this report, take it to a copy shop. Here are the print parameters to print it and to get it perfect bound. You can do that at cpmgroup.com. You can also go to some of our YouTube programs and you'll see there's a link so that you can plug in. We will have a briefing next Wednesday morning, April 6th. We will have an online briefing that's free and you can register for it and plug into that briefing. And then there's also a URL on our recent YouTube videos where you can actually order the book by just clicking on it.
Excellent. All right, Jeff, appreciate your thoughts. Thank you for coming on today.
I appreciate being there.
And thank you for watching Kitco News. I'm David Lin. Stay tuned for more and don't forget to subscribe to our YouTube channel.